In this video, I sit down and have a chat with the one and only Martin North. We go into how the Australian property market works, how the media manipulates the market. We go over the scenarios where property prices could rise or fall, and we also go over the central banks, their policies, what they're going to do moving forward, which could affect the property market, and whether central banks are fit for purpose. And we also get into some of your questions about the Australian property market. So sit back, relax, and enjoy the show. Hi everyone, I'm here with the one and only Martin North. And for all of those that have been living under a rock in Australia and that haven't been following the property market close enough, Martin North, do you just want to give a quick introduction of yourself?
Yeah, hi, and hi to your viewers, and great to catch up with you. Been following your channel for a little while. Digital finance analytics has been around for quite some time. We probably started talking about finance and property 8 to 9 years ago now, and we have a channel, we have a blog, but it's trying to basically help people understand more about what's going on, because there's so much spoofing going on, there's so much high-level stuff, there's so much media stuff that's all sort of pointing in one direction when the truth is somewhat different. So DFA is about helping to try and shed a bit of light and hopefully help people make better decisions.
Fantastic. And yeah, I think we do need more of a balanced view there. And I've been loving the work you've been doing, because it seems to be a one side of the story that, the market always goes up and doubles every 7 to 10 years. So we need more people to speak up and say what's really going on. So I thought we'd just get into
it. The point is, I was going to say, the point is that, you get one side of the story, but there's just so many powerful forces all on one side of the equation, right? So it's really important to try and provide a bit of balance. And some people accuse me of being a property bear, which I'm not, but I am a property realist.
Yeah, and that's what I try to strive to be, more of a property realist than a bear. And that's what I think people lose. The mainstream media might have put on some of your extreme scenarios out there all over the media and then say you're wrong, but you actually have 4 different scenarios, because at the end of the day, there's so many different variables that could happen, and you can't predict to exactness, what will happen to the market. So you do have to say, okay, if this happens, this is what could happen, etc.
You're right about that. And the point is, economists love to try and model things. The point is that you can't model something that's got so many independent variables that work in all sorts of different directions. It's more like trying to model the weather than an economy, right? And so that's why I believe that different scenarios are really important, to be able to show people some of the different things that could happen. And then they should make their own minds up as to where they think it's likely to play out. So that's much better than being definitive on one day and then next day changing your mind again and then changing it on the third day. I mean, CBA a few weeks ago said prices will drop more than 30%. And then, a couple of weeks later, said, no, it might be slightly down, but then up 10%. So, I prefer to be providing a sort of a canvas and allow people to understand how all of these things interact.
Yeah, I think that's kind of a forgotten skill, thinking for yourself and looking at both sides of the story, because I'm a bit weird. I'll listen to the extreme spookers like Christopher Joy. And then I also listen to those doom days, that there's going to be, imminent economic collapse. And I try to take both sides of the story, because some people do have their biases on both sides, and then just take the information and really think for yourself, okay, what does this mean for me?
And the point there, I think, is that you need to sort of step back and say, they're all operating within a particular worldview, or what I call a frame of reference, right? But there are some reasons why the frame of reference is the way it is. And sometimes it's because of the fact they're in the property sector and want property prices to go up, or they're in the bonds market, so they actually want to push bonds in a particular way, or they're connected to a particular media organization that has a particular bias that they want to pursue. So it's really important to stand back and just say, well, hang on a moment, they're saying that, but why aren't they saying that? And I'm a philosopher by training, so I tend to want to ask the next why question and the next why question, right? And then you start to realize that part of this change of view is because there are some irreconcilable differences as to how the world is thought to operate. Mm-hmm. And therefore, sometimes you won't be able to find a compromise, right? Because you've got to actually pick a side, right? If you have a particular worldview, then of course property is always going to go up, and you can never lose. If you're another worldview, then you might have a different view. So it really is important to stand back and think for yourself and begin to construct your own view and question your underlying assumptions.
Yeah, that's what I always try to do. And I think that's what the media trying to do. Like, oh, thinking for yourself, that's so to 2018. It's too hard. We'll think for you.
Yeah. Well, I tell you what, a lot of people just want the 2-minute YouTube video and then sort of go on the next thing, right? Now, unfortunately, I must tell you that that's precisely the wrong way to think about this stuff, right? It is worth spending a bit of time and effort to think it through and ask some harder questions, because once you start unpeeling the onion, you then realize just how fragile this whole discussion is and how many assumptions are driving it. And as you begin to unpeel it and be getting into the heart of it, you can begin to realize then that there are decisions that you can take which are actually way better for you long term. So it actually has a consequence, not just theoretically, but practically in terms of where you invest and how you invest, and whether property or some other asset class is a better deal. So it does have a real world consequence as well.
Yeah, fantastic. I think that's all great points. And I guess that leads us into my next question for you, and just kind of to quickly explain to our viewers how the actual property market works, because we see these averages come out like Melbourne's dropped this much, Sydney's dropped this much, or even worse is they say, okay, the national property prices have dropped this much, where really the property market doesn't work like that. Melbourne, every suburb has its own market. In Melbourne, there's a southeast, there's a northwest. And so, things could be happening one side of town or even one part of the suburb, and it could be different in the other part. So you kind of want to quickly, just a quick overviews of how it's all individual.
Well, there is no such thing as the property market, right? There are a series of micro markets. And in fact, even within one postcode, you can have different markets, units, houses, different parts of a postcode, might be in some cases views, in other cases less so. So you have to go granular. The other point to make is that a lot of the reports are on these property indices, right? So as well as actually aggregating everything up, they then add an extra layer of complication over the top to try and give an index. And often that index is black box, so you don't really quite know precisely what's gone in and what assumptions are made. And so therefore they pluck this number out of the air and say prices have gone up, 3% or whatever it is, without really explaining all of the processes that go through. The only way to understand what's going on with property is to go really granular and look at individual sales in individual locations, and to understand that there is no such thing as a single property market. And so I get really cross when all the mainstream media just picks up these high level indices and says, oh, whoopee, the property market's now booming, right? Or the property market's going to crash. No, it's way more complicated than that. And it's really important to get granular, right? And quite often, actually, even the information on many of the real estate portals is just completely, opaque is polite, I guess. For example, when property is sold, they quite often don't put the sale price up. So you see last asking price. Many auctions don't disclose the closing price on the auction. And many auctions actually, which are reported as actually successful, aren't successful, and then the property pops back on the market next week. So all of those things are in the mix, right? And so you have to get granular. You have to understand that there is a need to really look in detail at each individual element within the property market at a granular level. And actually averages don't tell you anything at all. In fact, averages just mask.
That's right. And isn't the data that we normally get, say, for example, if CoreLogic puts out their data for September, how old is that data? Is it 3-6 months old? So it's not actually reflecting what's happening right now?
Well, that's an interesting question, because CoreLogic will say that they have these information feeds directly from the real estate agents. So, they're talking to them all the time and phoning them up and getting all the up-to-date information. But the issue is that settlement prices, they are the definitive transacted values, right? Don't come through until the final sale is passed and money's exchanged hands and the transaction is settled. That typically takes minimum maybe 6 weeks, 8 weeks, 10 weeks maybe. But when I bought and sold not recently, some time ago, I had a 2-year settlement.
2 years
on that transaction? Yeah.
Wow.
2-year settlement on that transaction. So my transaction didn't appear in any data for 2 years, right? So that just illustrates the problem. Now, the question is, how do the indices get adjusted for that settlement data when it comes in, right? Because it comes in 2 or 3 months later, because you would expect to see some back changes to some of the indices, but don't see it, right? So my view is that the official view is, they're very up to date, very dynamic, and I'm telling you the information as at yesterday. The truth is, I think, somewhat different from that. And different, players have different indices and different methodologies. All I say to people is, don't just swallow it whole, right? Just understand that there are some questions that are worth asking about it. They may help you if you want to try and track trends over a long period of time. But just remember, it could be a matter of weeks or months before the full data is adequately reflected. And even then, if you start messing with the data based on numbers of bedrooms or different locations. There are ways of messing with the data, so you actually don't know whether it's more accurate or less accurate, right?
Yeah.
And of course, the people with the indices will claim that this is super duper, the most accurate, most shiny thing that you could ever get, and it's the best in the world, right? Well, of course they would say that, right? They've got a vested interest in talking up their index and talking at their approach, and that's fine. I understand that. That's pure business. But interestingly, if you actually compare the information from various different portal providers, right? Even if you look at trends in a particular postcode, you'll see trends are quite different. So quite often you get different answers from different providers of information. And that tells you that it's way less straightforward than you might think. Also make the point, of course, ABS, the Australian Bureau of Statistics, uses the CoreLogic data series as the prime driver for their analysis. They used to do their own, but now they don't. And so there's an interesting observation that the official statistics will be to some extent based on the CoreLogic information, but they actually do make some further changes to the CoreLogic systems as well. So essentially, this is a muddy area, right? Those indices are way less robust than many people would want them to be. And indeed, of course, they get picked up by the media again and again and again, and suddenly they become the source of truth. I would just say it's worth questioning them. Just take them with a pinch of salt and go granular.
Yeah, I think that's fantastic advice. And that's what I've been trying to tell my viewers is, the property market's not just one market, and you need to research your own suburb and do it the old fashioned way. Go to open for inspections, go to auctions. And once and like you said, there's the 3-bedroom, there's a 4-bedroom. If you're after a townhouse unit, they're different markets. So you need to really target what type of property you want, what suburb you want. Go to a bunch of open inspections. If you've been to 100 open inspections and the average price is 400, and then all of a sudden you come across one that's 370, is a good deal. Where if you see something that's 440, then you go, okay, this is a bad deal. So I guess it's the old-fashioned way. Get out there, get away from the computer, and get in the real world.
Well, but there's also there is another in New South Wales in particular. For example, the Valuer General data is actually publicly available, right? So you can go in, and for any postcode for any type of property in New South Wales, you can get all the settlement history going back multiple years, right?
Oh, that's nice.
Now that is the most definitive set of information for New South Wales, right? I use that a lot because that tells me everything that got settled, right? Now, most people, when they're looking for property, don't even know that portal exists, right? But it does. And I recommend that as one of the most definitive sources of information in New South Wales. Unfortunately, a number of other jurisdictions, they've privatized that information source, and that information is now not publicly available, but it is in New South Wales. So that's definitely worth visiting.
Oh, too bad for me. I'm here in Victoria. So I guess we'd, want to get into, the big topic about what's going to happen to, property prices, short-term versus long-term. The way I'm looking at it is, like I said, I'm looking at both sides of the story. We've got two forces. We've got interest rates dropping. We've got the RBA's term funding facility where they can offer lower interest rates to home buyers. We've got the $5% first home buyer scheme extended. And that's been increased to, people that are struggling to buy houses close to $1 million. They can now help out first home buyers to buy expensive properties. And we've got things like the home builder scheme, the other first home buyer grant. So we've got one side where the government and the banks are trying to really, lift up house prices or stop them from falling. But then we've got all these other risks in the economy like JobKeeper. I think Josh Frydenberg was saying it's likely it's not going to be extended after March. He was saying, and the same with Job Seeker. We've got the businesses trading while insolvent that are going to affect the good businesses. Potentially they can rack up a big bill and then not pay for it. We've just got so many risks, and I'm just trying to figure out what's going to win, because what people really need to understand is what's fueled property prices over the past 30 years is interest rates in the 90s going from 18%. And now you can get interest rate for 2%. And I did a calculation. A property of $100,000 or a mortgage of $100,000 at 18%, you're actually paying more than a mortgage of $400,000 at 200%. So people can now borrow 4 times the amount that they were doing in the 90s to bid up property prices, and it will be more affordable. So that's really why the spruikers say property prices double every 7 to 10 years because of low interest rates and easy lending. But what are they going to do now that they can't lower interest rates? So what
Well,
do you think about that?
you've hit the nail on the head, right? So there are two sets of countervailing forces, right? There are a bunch of forces that will try and push prices higher. And, ScoMo around the last election promised that prices would be higher under him, right? So you know which side of the argument he's going to land, right? And we've got lower interest rates. We've got looser lending standards. We've got the extended pretend processes with regard to loans, all of those things. And, there are a whole bunch of reasons why the Reserve Bank and APRA and the Treasury want prices to remain high. They don't want the banks to be under pressure, because if prices started to fall, they'd have issues with their existing portfolio. They want to try and suck more people in because the Ponzi scheme needs to be fed. You need more first-time buyers coming at the bottom of the hopper buying to support the whole of the edifice, right? And that's one of the reasons why the first home loan programs are there now, and quite a few people are going for those, despite the fact that I think they could be making a big mistake. And the point you make is really important. There was deregulation in the 90s, right? There were interest rates coming down in the 90s. There was the RBA policy of using housing and the household sector to try and drive the economy post the mining boom, right? And that supported very high levels of debt. So we've got some of the highest debt in the world. But if you look at the average repayments, they have hardly moved at all for many, many years. So as rates have come down, people have been able to extend and multiply. Even today, the typical loan to income ratio is perhaps 6 to 8 times. That's way higher than it used to be at 3 to 4 times. So that's the reason why people will then say, well, that can continue, right? So we can take rates even lower, we can extend even larger loans, etc. So that's one side of the argument. And, that some has some merit, but I have to say that the weight on the other side, which is migration's pretty much stopped. And in fact, in the budget, they said that net migration will be negative for 2 years. So we don't have foreign people coming into Australia to buy property. We also know that many foreign buyers are now looking to sell rather than to buy. China's a good example of that. We know that there are a lot of households who are really stretched at the moment because their income has been squeezed because of no income growth for many years, as well as the virus. And we also know that many property investors are seeing rentals dropping and the capital value on their apartments dropping. And we also know, of course, that the construction quality of many apartments is pretty lousy as well. So it's going to be a tussle between those two sets of forces, right? And my own modeling is saying there is a scenario, if everything goes really, really well and all that stimulus that was announced last week hits the mark and we open the borders, well, I could see there is a path to price rises potentially. But the weight of the argument is for prices to go sideways or down. Going back to my point, you have to look granularly. And I think units more than houses, I do think units are already falling quite fast in many areas. I think houses closer into the cities will probably hold their value quite well because there's more limited supply. So I think houses are a better bet. But I also think some regional areas are now getting a bit of a boost because there are many people who are living in the urban areas thinking now, perhaps looking further out. They can work from home more easily now. NBN's there, I guess, as well. And prices are lower. So, you can't look at this as a single binary outcome. You have to look at, I think, a range of options. But overall, my own argument is there's a 50-50 chance prices are going to go down, probably even stronger probability that they're going to go significantly down. And the point to make is if you look at what happened post the global financial crisis, the falls happened over 3 or 4 years after that in terms of the US, UK, Ireland. So it didn't just turn around overnight. And that means we should be expecting prices to go sideways or down for a number of years. We should expect defaults to rise, but slowly. It will take a number of years. And therefore, whatever you think about property prices, looking over 3 months or 6 months is the wrong horizon. You should be looking over 2 to 3 to 5 years. And if you can say to yourself, I'm okay if prices drop and I ride it down because I can ride through it, despite negative equity risks, then it may be okay to transact. But if you are looking for that quick buck, if you're looking for that doubling of prices every 7 years, which many people still believe, forget it, we're not going to see it. So that's where I'm at. So I think more down than up from here.
Yeah, no, and I agree. I think, like you said, there is a chance that all this stimulus in the short term could have a spike in some areas, maybe, or definitely not Melbourne, because things are still going bad here. I'm not sure about Sydney, but maybe in places where it's a more affordable, like WA and Queensland. But we do have to look at the long term because, you know, when you buy a house, normally you get a 25, 30-year mortgage. It's not a 2-year thing. And like I said, with this recession, it's a strange recession because some people will be doing better than ever, but that hasn't played out yet. What is affecting those one group of people, it hasn't started to affect the other group of people. And from all the government stimulus, people have been making more money so they can spend. But once that gets taken away in March, it's like you said, it's going to start playing out. And recessions, you know, they say, oh, it hasn't crashed. It's been 6 months. Well, it's because, like I said, people have been doing pretty well. They've taken money out of their super. They've been, you know, maybe a couple could have taken $40,000 out, even if they weren't eligible. So yeah, we've got all this stimulus. Short term, it's looking great, but that's all going to be taken away in March. So I'm really interested.
It's really interesting if you look at the amount of stimulus that was in the system, right? It was more than 22% of GDP. This quarter, it's 7.5% of GDP. Next quarter, it's about 2.5% of GDP. And even if you overlay back in all of that budget stimulus, right, which was announced last week, it's still net negative in terms of the overall quantum of stimulus into next year and the year after, relative to all that spike we've had. So net, we are draining money out of the system. And we've got high savings ratios at the moment, high broad money. But those things will dissipate over time. And then we'll start seeing what's really going on. And I actually think that we're going to see some of the most significant pressures in the more affluent household sectors who are highly leveraged with multiple properties. Suddenly all those properties start going down at the same time. Their rental streams are actually being squeezed at the time when structural unemployment starts to hit. So some of those big jobs disappear too. All of those factors, higher unemployment ahead, everyone's saying it's going to be higher, it's a question of how much higher. All of those things need to be factored into your thinking if you do honestly believe that prices will go higher from this point. So there may be some small move up, but I think the overall conclusion I come to is gravity is going to win. And remember this, that actually if you compare all the ratios with long-term averages, property prices in Australia are 40% over long-term value, 40%. So we are in bubble territory, but it's a strategic bubble rather than just a tulip bubble, right? It's a strategic bubble because of poor policy for many, many years. And it's going to take some time to sort of shake out. And actually, the problem I've got is if you actually allow it to continue for a bit longer, then the fall when it comes will be even more significant. And that could create even more significant issues for many people. So it's like, do you want a mid-sized correction now, or do you want an even bigger correction later? And I think, frankly, the long-term solution to housing affordability is to let prices come back to long-term averages. And in fact, there isn't a bubble around the world that has not actually ultimately corrected. It just takes a lot longer than people think.
Yeah, I completely agree. And that's what I'm concerned about is all of our wealth is being put into, you know, one asset class, property. And, you know, any investor would tell you, you know, diversify, don't put all your eggs in one basket. But it seems like the government just keeps putting more and more money in housing. So then that means it's more and more of a risk to the economy if they let it fall. And they're kind of just backing themselves into a corner.
Well, but the question is, why are they putting all that money into housing? It's not to encourage and allow first-time buyers into the night. It's not dealing with housing affordability. It's to support the construction sector, right? There's 1 million construction jobs, right? And there is a very strong alignment between politics and construction, and there are very big forces. And by the way, the banks, of course, are also on the same side of the argument too. So you need to understand it's the political environment, it's the financial environment, and it's the construction sector, all of whom are being supported by all of these stimulus. And frankly, I called the budget last week. It's actually a bank keeper program, right? What it's designed to do is to keep prices up, and it's a construction sector keeper program. That's actually what it's about. And first-time buyers are effectively the cannon fodder that are going to be used to try and support this bubble for longer. That's why I think people need to be a bit cautious just now.
No, I completely agree. And that's why I keep telling my audience, if they really wanted to help out first home buyers, take all these schemes away and let the bottom end of the market have a more affordable entry point.
Settle. Yeah.
Yeah. Because what this does is it lifts the affordable end of the market up. And so when there's a correction, the upper end of the market may move first, but then if they keep throwing this stimulus at the lower end of the market, it supports low end of the market. And so then it creates it harder for first home buyers to get in.
Yeah, and a good example, if you look at Western Australian, right, there was basically a 55K combination of federal and state support for buying off the plan properties, right? When it was announced, guess what happened to prices of homeland packages? It went up by precisely $55,000. It was a zero-sum game. So anybody who's now buying those things, and many are paying more than they would previously, right? So that's a great example of, it lifts all the boats in the harbor, but it doesn't actually solve anything. It just makes things ever more unaffordable. And of course, people will be buying new property that probably will lose value, as they often do once they've actually been completed. And they've got to sit there and wait for a year or so while it's built. And if prices do continue to fall, remember that in WA, they're down more than 22% on average. In some postcodes, they're down 38% from peak. Lots of downside risk in WA, and yet people are being sucked in. It's, I think, frankly, some of the politicians should be accused of being offering financial advice, and probably should be taken to ASIC and saying, you shouldn't be saying that. But of course, that's something that the politicians get away with.
Even with the media, like the articles that they put out where they create FOMO and try to get first home buyers to rush in and take up these 5% deposit schemes. I'm like, this is terrible financial advice. There's no disclaimers or anything that I can see. But it seems like, you know, if you did that in the stock market, manipulating stocks, you know, you could go to jail. But with the property market, they can manipulate it all they want.
Well, unfortunately, that's true. I did a post yesterday when I said every prospective first-time buyer should watch my show, right? Because I basically said, look, this is what the government's saying. You know, it's all wonderful, but this is the truth, right? You will end up paying more because the interest rate will be higher. And in fact, the chances are that whilst you might save a bit on lender's mortgage insurance, you'll be spending a lot more over the life of that mortgage. And there's huge risk to the downside, right? And yet most people, if you talk to first-time buyers, think that the government's out there to help them. No. The government's there to support the construction sector. First-time buyers are just cannon fodder.
Yeah, exactly. And like you said, that's exactly what I saw in Melbourne when the government announced the 20K for building in regional. So I'm on the edge. I'm in Melton in Melbourne on the western suburb. And then the next suburb to me, 5 minutes away, is Bacchus Marsh. As soon as they announced that scheme where instead of building in metro, you get 10,000, but if you build in regional, you get 20,000. All the house land packages went up 20 to 30K. This was around 2017. And yeah, like I said, what I'm worried about is they're saying that home builder will fuel house prices, but you get this scheme to build a house and it's all brand spanking new, and they inflate the construction cost. But then when it's an existing house and, you know, if you try to sell it 3 years later, the buyer's not going to get all those schemes. So the resale price may not be anywhere close to what you paid for it when you built it.
Yeah, well, I use the analogy of buying a new car, right? As soon as you drive out of the forecourt, the price drops. Well, same with brand new property, because you often buy property with all the new things, you know, all the shiny kitchens and everything else. The fact is, quite often prices slide. And there is very little evidence that I can see of any sustained long-term capital appreciation from this point in the cycle, right? And that's what people need to understand. Even if prices don't fall, we are not going to see the same growth that we saw over the last 20 to 30 years. Those were unique situations. In fact, there's only twice in the whole history of property in Australia where prices moved higher than inflation. The first was after the Second World War, and the second was between 1990 and 2020, right? All of those two situations were unique. The rest of the time, prices are moving just at inflation, which means there's very little capital growth ahead and more likely to be falls.
Yeah, no, I completely agree. And like I was saying, I think that's just because of the lowering interest rates, all these first home buyer schemes, they created mass immigration. But yeah, we're probably not going to have all those scenarios happening over the next 20 years. So I think another thing I'd like to get in with, I'm starting to see a trend like with the media and with the articles come out, like you were saying before, with CBA putting out, you know, articles saying it's going to drop 32% and the RBA putting out predictions it's going to drop 40%. Now that I've watched, you know, a couple of short-term cycles, because I've been following it for about 8 years, I'm noticing a trend where they'll put out these articles, and I wonder if it's to scare the public and to scare the government into, hey, you better do something, you better intervene into the market, otherwise it's going to crash. And then obviously, you know, most people own a home, so they don't want their property prices to crash, and then it kind of forces the government to create these schemes to keep the property bubble going. And then obviously then they change as soon as they announce those schemes, like, oh no, it's all good now. Yep, thank you.
Well, I think there are two observations. Many of the economists are attached to the big banks, right? And of course, the big banks make most of their money from mortgages. So the last thing they want to do is to see property prices fall or mortgage momentum ease. both of those are relatively terminal for the banks in terms of their profitability, right? So most of the time they tend to be on the bullish side of the equation and will use all the data that they can to be able to tell that story. Now, I have to say I was quite surprised when CBA said there's a scenario of 32% down. That was within sort of my ballpark as well. And so I felt that they were actually being quite frank about it. But, you know, you have to say, well, I wonder why that was. And you're quite right. Quite often it could be to lobby, and they do lobby very hard for more government action. And I have a theory, and I can't prove it, but the extension of principal and interest holidays, which the banks offered, I suspect was a trade-off on the basis that the government would actually deal with the responsible lending obligations, which of course were a real thorn in the side of the lenders. So I have a feeling that there was a deal done under the table, as it were. So if you give some support to keep those loans going a bit longer, we'll deal with the responsible lending. So that's the first side. The second side is the other information source, of course, comes from the real estate portals and all of the media attached. And it's worth just reflecting. Domain is attached to Channel 9, and realestate.com.au is News Corp, right? So these large organizations have huge interests in the property sector because they've got interest in these portals. And of course, they have huge influence in terms of newspapers and now online and of course TV. So it's not surprising perhaps that many of them are, again, talking property up. And frankly, many of the articles that I read, I find shameful because somebody will just pick a single example of a property that went over the reserve and try and extrapolate the whole market from that particular story. But they never tell you about the 9 that actually didn't sell or sold below the asking price. And it's getting worse and worse. There's more and more spruiking going on at the moment. And I have this theory. I create my own index, actually, called the spruiking index, which basically says the worse things are, the more the spruiking is out there, right? And I tell you, it's reached fever pitch at the moment. I'll give you another example. I made a post on Saturday looking at the Cairns property market, right, which is doing pretty badly at the moment. And I had a number of people in the real estate sector saying, no, you're completely wrong. It's just turning around. You know, there's an uptick. Yeah, sure. Believe that when I see it, right? The fact is that many people within the property sector and many people within the media sector who are often linked, and linked, frankly, to, the government policy things as well, they're all on the same side of the fence and all just wanted to talk it up. No, let's get some reality and some truth in reporting. And frankly, there should be much more disclosure in all these articles. I think every time, we see Domain writing something, right? We want a disclosure to say they're part of this, and no, people just take it. So my argument is there has to be more transparency and more objectivity in reporting, and frankly, that's where I think we're going wrong at the moment. So spruiking is through the roof, but that's one of the reasons why DFA exists, because I'm trying to be an antidote to spruiking, right? I'm trying to give people a more realistic view of what's going on, and help them make better decisions rather than just being caught up in the fear of missing out. Because a lot of people, when it comes to property, you try to be objective and, data driven, but the psychology kicks in, right? And psychology can be really powerful. The analogy I use is lemmings, right? You see one lemming going over the cliff and everybody else follows, whoopee, right? Well, my argument is property market's just like that. You want to be very careful you don't end up as a lemming.
Exactly. And didn't Domain just get caught out for putting out a fake news article and they got in trouble for that?
Yep. And then they did pretty much the same thing the following week. So
yeah, exactly. And that's something that shocked me when they removed responsible lending. And it's also a bit of coincidence that all these mortgage holidays are due to expire in March and the responsible lending laws start in March, that they're going to be eased. And didn't we just have a banking royal commission? Like what happened if all of a sudden there's, when we're heading into a recession, but now there's no risk. Now all of a sudden, they can lend. There's no risks now. And also with all these interest only loans that were huge risk, now all of a sudden they're not a huge risk anymore. Everyone can just get an interest only loan. It's absolutely crazy.
Well, but that's the virus, you see. It's all down to the virus, right? We were doing fine, but the virus came in and we have to respond to that, right? Now, the truth is, we were digging a hole for ourselves before. The virus just accelerated some of it. And I'm amazed that the banks are now willing to offer interest-only loans, and the regulators are quite happy with that. The fact that APRA has allowed banks to report bad loans as not bad loans for a period, and so many other things. The responsible lending issues, which were not perfect by any means, but at least gave some consumer protection, are to be removed, assuming it goes through Parliament next March. That's all a late cycle sign, of my view, that we are close to the end of the upside, right? And in fact, there were similar things that went on in the US just before the global financial crisis as well. So my own view is I wouldn't expect anything different, but the regulation needs to actually understand that this is an unequal conversation between a lender and real estate entities and individual borrowers, right? No way can you put all of the obligation on borrowers, right? There has to be some balance. There has to be some understanding that there is accountability and responsibility on behalf of lenders to do the right thing and not to allow loans that should never be written to be written. And then turn around and say, well, it's down to the borrower because it's all down to what they disclose. And if they want a big loan, that's fine, it's their problem. And remember this, we have full recourse in Australia, right? Which basically means if you get into difficulty, and even if you sell your property and then you've actually still got a loan outstanding because property prices fell, you still owe the loan. The only way out is bankruptcy. And unlike in the US where you can just hand the keys back and say, cheers, you can't do that in Australia. So what that means is that this is all about funding the banks through people paying their mortgage repayments. And remember that everybody who's paying a mortgage repayment is effectively a cash flow to the bank. That's all they want. They just want you to keep paying and keep paying and keep paying. They can extend the life of the loan. They'll give you interest only. That's fine. Just keep paying, because then they can say everything's fine and we'll go on making profits, right? And that's without really, I think, the right amount of obligation in terms of scrutiny and in terms of doing the right thing for consumers. So consumers will be extremely exposed. Many will just be persuaded to borrow regardless. And frankly, quite often things don't go wrong immediately, but it's down the track. Look at Western Australia, all right? And I keep quoting Mandurah as a postcode which I looked at from a mortgage trust perspective some years ago. And now we're seeing it all terrible, 38% down in prices, lots of people in negative equity, many people now, frankly, having to sell. That's where you end up if you're not careful. So this is a big deal. And that's why I believe that people should take some accountability and responsibility for themselves, but there should still be some appropriate protections to make sure that people don't end up with loans they should never have had in the first place. And frankly, just using financial stability, which is what APRA is doing, and just saying, well, as long as the banks are managing their risks okay, no, that's not the only way to think about this problem. But that's actually what we end up with, is all the rest of it's down to consumers.
Yeah, no, that's completely right. And that's what I agree with. And I did see that, there were some scenarios where maybe the banks were being a bit too strict there for a little while during the Banking Royal Commission. But like you said, we do need to have common sense and they do need to protect people that aren't financially literate, because there are so many people, if the bank just says, calculation, okay, you can borrow 700,000, they have no idea, what that repayment's going to be. They'll just go, yeah, okay, I'll take 700,000. So there does need to be a balance there. I agree.
Yeah, well, the point is this, that, the banks make some assessments of the risk of not getting paid back. That isn't the same as they saying, yeah, your loan is fine and you'll have no problem repaying it. That's completely different, right? So the risk analysis that they do is not the same risk analysis you should do as a borrower, right? And yet most people, if the bank says, yeah, you can have a loan, they assume that the bank has actually looked at it from your perspective. No. They've only looked at it from their risk management perspective. Remember, if you've put a 20% deposit in and prices drop 20%, you lose everything, right? The banks lose nothing.
Yeah.
And therefore it's a very unequal situation. Actually, I think the right argument would be that if prices drop, the value drop should be shared equally between the borrower and the bank. And that would actually, I think, change the game. The second thing is, I wonder whether we should change recourse. I think perhaps the right answer would be that we should have the same arrangement as in the US, where if you get into difficulty, you can just say, here's the keys. That would focus the minds of the banks a bit more, and rather than just lending more.
Yeah, exactly. I think that'd be a great idea. And talking about banks, I'd wanted to get in a little bit into central banks and what they're doing, because obviously they're big major players in the game of fueling asset prices and creating wealth inequality. And I looked at an article about an RBA employee that resigned, Mr. Tulip. I thought it was funny. His name's Mr. Tulip. I hope he didn't want to, go down the MMT and create tulip mania. but and he's talking about how he thinks the central banks don't act in the public interest. But as far as I was aware, you can correct me if I'm wrong, I thought central banks were created in the 1900s because there were so many bank runs on the banks, and they were more created for financial stability and for the banks rather than the public interest. What do you think about that?
Well, I mean, the history of central banking is quite interesting because the central bank was never actually there to do other than provide a backstop to the banks to stop the banks from basically falling over, right? So, and in the US, the Fed is owned by the banks, right? Yeah. So the point there is, in the US, every time the Fed is doing something, it's always doing it with the shareholders and stakeholders of the banks in mind. Now, okay, it has this other obligation in terms of, the broader economy and everything. Now, here in Australia, the Reserve Bank is owned by the government. It's, it's a dividend goes back to the government, and it has this sort of lofty mandate of trying to maximize employment and this and that and the other, et cetera, et cetera. And it's meant to be independent and, all of those things. But just to be clear, Reserve Bank, APRA, ASIC, Treasury sit around the table in the Council of Financial Regulators. So that's where the sort of the planning is done. That's not independent. The Reserve Bank is myopic, and it has rose-tinted spectacles, and it doesn't really understand what's going on. I think the number of times I read stuff when I think, no, you don't understand what's going on. They're using old data. They're using 3 or 4 year data from Hilda, which is a one survey, but old survey, right? There's so many examples where they don't really tell the full story. And so my view is the Reserve Bank has become more a propaganda arm of government than actually somebody who is objective, independent, and rational. It's also, of course, connected to the other central banks around the world, who all tend to be on the same neoliberal trip, who believe that more debt is fine. In fact, there's no limit to how much debt can be pumped through the system. And that's my fundamental problem, right? Central bankers have lost the plot. And, this quantitative easing and all of this liquidity creation, all this money supply creation won't work if, in fact, there is no demand for more credit. And we know that many businesses are unable to take more credit because they don't have the cash flow to support it. We know many businesses are struggling, and we know that many consumers also are concerned because of low levels of confidence and concern about income. So they're not actually going to borrow more. So you can create all of this pool of really cheap money, but if it doesn't actually get taken up, then the whole thing moves into deflation rather than inflation. And that's what I see probably. So my theory is that over the next 5 years, we'll end up more like Japan rather than in a hyperinflated economy. And that's because credit only works if more people can take credit and if there's more demand, and there's no demand at the moment. So I think central banks have lost the plot. In a way, Peter Shit's right. I don't necessarily agree with everything he said, and some of his reports were very myopic in their own right. But he's actually right here. Central banks in Australia, the central bank in Australia, does not actually have adequate debate internally, doesn't actually get all the external information that it should be getting. As a result of that, many of its decisions are, I think, suboptimal. And in fact, their forecasting is even worse than mine.
Yeah, exactly. Yeah, they seem like they can never get it right. And it just seems like, to me, I'm just an everyday, Joe that's been studying economics and the monetary system. And the more and more I learn about it, I just say, it just seems like they're just creating asset bubbles. It doesn't, they say, oh, we've got to get, employment, down to 4.5% and all that stuff. But whenever they do these stimulus packages and lower interest rates, it just increases asset prices. The share markets go up, precious metals go up, and it doesn't seem to actually go down to the little guy.
Well, there's definitely, the 1% and everybody else. The other point I'd make is that, asset prices will go up in the short term, right? So, gold and stocks, but there will be a point where that doesn't continue. So I still believe that the stock markets will come back at some point. And another reason why I think deflation more than inflation is probably the most likely outcome. And the point there is that if you actually follow the neoliberal drivers, which is what central banks do, then you're very narrowly based, and you basically have a set of assumptions about the way the economy works. Going back to my frame of reference conversation, I think actually it works differently. And remember this, the old adage about deposits leading to loans is completely wrong. Actually, loans can create money. And so if you can create more loans, you can create more money, and you can create this quantitative easing bubble, and maybe. But if you can't get people to borrow more, then the whole thing just explodes and basically stops, right? And that's where I think we're getting close to now. So what happens if, in fact, all that credit, all that cheap money that's created doesn't get lent? Well, then we've got a big significant issue. So yeah, I think there's a big question mark over central banks. In fact, there's a question mark in my mind as to whether a central bank makes any sense at all. I would argue maybe we should get rid of it.
Yeah, that's what I've been thinking. I think they don't seem to be acting in the public interest at all. They seem to be acting in the bank's interest. And when we saw, house prices go gangbusters in 2016, 2017, they didn't lift interest rates. And now as soon as, there's a little crack in the housing market, boom, they lower interest rates straight away. So they seem just to be going one down one road.
Well, they can't admit that they've actually stuffed it, right? I mean, they've stuffed the economy in the last 10 years because they've actually allowed house prices to accelerate way too hard. They didn't lift rates fast enough. They didn't then deal with all those broader issues they should have. And we've now got the situation where they're trying to cover their tracks and trying to actually, protect that housing bubble. But it will end at some point. It's just a question of timing, and whether it's going to be 1 year, 5 years, I don't know. But this is an unsustainable bubble. It will correct.
Exactly, I agree. And like I keep saying, we haven't seen anything yet. I think the real test for the market will be after March. And again, the data's, lags a bit. So maybe it might be June next year till we start to see some of the cracks. Of course, unless, the central banks go completely nuts. And they've been talking, I've heard some central banks about a digital currency and creating a CBDC where you could download a wallet or create an account with a central bank, and they'll send you money, and they'll say, oh, you got to spend this money within, this amount of time frame, otherwise it will expire. And I'm like, wow, the things are getting, more and more crazy as the years goes on.
Well, there's no doubt in my mind that you could see a future where effectively digital currency is actually brought in. It becomes effectively the currency where it's more and more controlled. But remember, what we're doing here is we're putting more and more central control. We're losing liberty. We're losing choice. We're losing some of those things which Western societies always held as really important, which was individual responsibility and accountability and choice, right? It's becoming more and more a planned, controlled economy. In fact, China recently announced that they're moving to the next stage in their central bank digital currency testing, right? So they're going to actually hand out wallets to certain people on a lottery basis. They are way ahead of us. There is a concern, definitely a concern, that we could see this as part of a, not just a national thing, but a global thing, right? And I'm very concerned about some of those. I hope it won't happen. I think that we're sleepwalking, though, into a future where our own liberty is being taken away from us, and where, frankly, we're being forced more and more narrowly into a digital-only future, which potentially has more risks, less liberty. So again, we need to be, I think, open and alert to it, rather than just rolling over and saying, oh, blame COVID. No. We need to be much more alert in a way.
Yeah, I think, what they say, never let a good crisis go to waste. And definitely here, I'm in Melbourne, and they've just extended the lockdowns, and it's just getting completely out of control. And I'm very worried about these digital currencies. They'll dangle the carrot, go, oh, look, we'll give you, whatever, $5,000, $1,000. But how much is that worth to you, to losing your freedoms and all your data? And then, they can essentially plan everything.
Well, you could actually get to the point where, you need a social score. If your social score isn't up to it, you can't spend, or you can only spend on certain things, and even the digital welfare card, which already exists, is a bit like an early example of that. So this isn't just pure science fiction. This is actually, reality, or close to reality. So we just need to be really, really careful and cautious that we don't let ourselves get caught into this rather nightmarish digital future. I'm a great fan of digital. I think there's things it can do and things it should do, but empowering central banks to impose even more controls on us is not one of the things that should be on the radar.
Yeah, no, I completely agree. I like look at this technology we're using now, Zoom and stuff like that. There are good things to technology, but with me trusting all my data and stuff with the central banks, I'm not sure about that. But just a quick few questions from my viewers that posted to you. They're wanting to, I guess we're running out of time here, but just quickly, what you think about the Queensland and WA market over, the short term, and then maybe a bit longer term.
Okay, well, again, you can't just generalize, right? There is some signs in some markets in WA of stabilization. And indeed, rentals are quite tight over there at the moment. But if you look further out, there's still significant price falls. So there probably will be some stabilization, more houses rather than units, more closer into Perth than not. I don't see much of a price recovery, though. Although the economy in Western Australia is performing quite a lot better, thanks to iron ore, than most other parts of the country. Queensland is much more complicated. I was looking at Cairns, as I mentioned the other day. That's still looking pretty sick. Gold Coast, everybody's spruiking at the Gold Coast and Sunshine Coast as hot markets. There are a few pockets where prices are up a bit, but they're actually few and far between. A lot of that is because of interstate interest. That will probably continue. But if you look beyond that, there are still huge falls like Toowoomba, for example, and Ipswich. Those are very, very compressed and depressed markets. So again, I think that there are pockets of positivity, but I wouldn't say that the market overall in those two states are actually going to recover significantly. And, look at the growth. There's been no growth in Queensland for a good number of years, right? Mm. So unlike Victoria and New South Wales, where there was considerable prices, gone like that for quite a long time. WA's come down for the last 7 or 8 years. So it is due ultimately sometime to sort of settle. But interestingly, the real estate guys in Western Australia have published religiously every year, this is the year that prices are going to recover. And guess what? They haven't. So I'm going to be skeptical and I see the data really coming through.
Fantastic. And there was one last question. A viewer asked, and it got a lot of likes. Do you know any banks that have changed their T's and C's for bail-in, or maybe some banks where they don't have bail-in legislation or T's and C's?
The answer is pretty much all the banks in Australia have changed their terms and conditions to enable bail-in to happen. Pretty much across the board. So now, if you haven't read your terms and conditions recently, it's worth reading it, right? That said, I'm of the view that it's very unlikely that bail-in will happen in Australia because of all that central liquidity that we discussed earlier on from the Reserve Bank. That's given the banks a bit of a wriggle room. And I also think that the bail-in thing, if it happened once, would actually destroy financial credibility and stability. So it's unlikely. Also, there is the legislation which is coming up in the next month or so. The Senate are going to be voting on the amendment to the Bail-in Act. In fact, I'm going to be doing a show on that in about a week's time, because it will be easy to take out any other instrument piece and remove deposits as basically within scope. If you did that, then this will be fixed quickly. Interestingly, though, the government doesn't want to address that. So the government still wants the wriggle room. So we should be cautious and careful. But there isn't really any way out of it because pretty much all banks have changed their terms and conditions in recent times. So just worth reading them.
Yep, fantastic. Agree with that. Well, thanks for coming onto the channel, Martin. It's been a pleasure speaking with you. And there's, obviously so much we could talk about. It's a huge, huge topic. We obviously can't cover everything, but I do thank you for coming on. And how can people find you that don't know about you?
Digitalfinanceanalytics.com is my website. There's a blog there. And my web channel is called Walk the World. I do daily shows there, including live shows from time to time, covering finance and property news with a distinctively Australian flavour. So always good to see more people coming on. I hope you continue to get subscribers on your channel. I'll make sure that people are aware of you as well. So hopefully we can get a bit more traffic coming your way too.
Fantastic. Thanks for that, Martin. Really appreciate that. I think we do need more of that, some other views coming out. And I think the Australian people are slowly waking up to what's happening and how the market is being manipulated. So thanks again for coming onto the show, and I'll hopefully speak to you again soon. And thanks to everyone for watching.
Cheerio.
Thank you.